Have you ever wondered why even with great analysis, the price sometimes moves against you? It's not because your strategy is bad, it's because you are missing a crucial piece of the puzzle, the news. Or worse, maybe you are following the news, but you're not focusing on the right headlines. Half of the time, market moves are driven by global events and macroeconomic reports, not just technical patterns. Today, we'll dive deep into how to analyze news for trading, where to find the most crucial macroeconomic updates, and which ones can make or break your trades. By the end, you will know how to spot the key events that can help you profit. And before we get started, don't forget to subscribe to my channel, where I post tons of educational content. I break down complex topics like interest rates in simple terms and provide market analysis, entry points, and insights into various assets and projects. Stay informed and boost your trading game. The key news events that impact market. Let's explore the main types of news that heavily influence market prices and what you should be looking for when these reports are released. You can always check for economic calendar on investing.com. Non-farm payrolls. What it means? The non-farm payrolls report NFP measures the change in the number of employed people in the US economy, excluding the farming sector. It's one of the most significant indicators of economic health. When employment is rising, it generally indicates a growing economy. Conversely, a sharp decline can signal an economic slowdown or even a recession. How it affects the market? The NFP often causes huge price swings, particularly in forex and stock markets. A strong report can boost confidence in the US dollar and equities, while a weak report can trigger fears of an economic downturn, leading to sharp sell-offs. The same for crypto traders. Next, unemployment rate. What it means? The unemployment rate is the percentage of the total labor force that is jobless but actively seeking employment. Like the NFP, this is another key indicator of economic performance. How it affects the market? A rising employment rate can suggest economic weakness, leading to bearish sentiment in the markets. It can also signal that the central bank might lower interest rates to stimulate the economy. For crypto traders, this could mean more market liquidity, as a lower interest rates environment often drives risky investments, including digital assets. Federal Reserve interest rate. What it means? The Federal Reserve sets the benchmark interest rate, which dictates how expensive it's to borrow money. These rates influence everything from mortgages to credit cards to corporate loans. When the Fed raises rates, it's generally trying to cool down inflation. When it slows rates, it's looking to stimulate the economy by making borrowing cheaper. So how it affects the market? Federal decisions are some of the most anticipated news events for traders. A rate hike usually strengthens the US dollar and puts pressure on risk assets like stocks and crypto securities and cryptocurrencies. On the other hand, a rate cut can lead to a surge in risky assets, as lower borrowing costs increase liquidity and drive investment into higher risk opportunities. By the way, I've broken down the process of how interest rates impact the crypto market in more detail in one of my Telegram posts. Make sure to check it out. Next, inflation report, CPI and PPI. What it means? The Consumer Price Index, CPI, and Producer Price Index, PPI, measures inflation at the consumer and producer levels, respectively. These reports show how fast prices are rising, which directly affects purchasing power. How it affects market? High inflation often pushes central banks like the Federal Reserve to raise interest rates to cool the economy. For crypto traders, rising inflation could lead to central bank tightening, reducing liquidity in the market, which is in fact bearish for assets like Bitcoin. Conversely, when inflation is lower than expected, markets may rally on the belief that central banks will hold off on raising rates. Geopolitical events, finally. What it means? Geopolitical events such as wars, political instability, or trade disputes can have a significant impact on global markets. These events can disrupt supply chains, cause uncertainty, and shift investor sentiment quickly. How it affects market? When uncertainty arises due to geopolitical tensions, investors often seek safe haven assets like gold or even US dollar. Risky assets like cryptocurrencies can see increased volatility. However, for long-term crypto enthusiasts, geopolitical instability can sometimes boost the narrative of decentralized assets like a hedge against traditional financial systems. There is an example of news analysis. Let's put this into practice with a real-world example of how news impacts the market. US employment change, for example, market expectations. A decrease in employment from 233k to 166k. Actual 146k. Commentary: these figures are below expectations, which might increase the likelihood of a rate cut in December. If the Federal Reserve lowers rates, borrowing becomes cheaper, liquidity increases, and market typically reacts positively. However, there is also concern about a possible US recession, which could create more cautious investor sentiment and lead to a local market correction. The slightly lower than expected drop may not alarm investors, but could push the Federal Reserve towards easing monetary conditions, which is a positive sign for the market. By the way, I often observe such cases in my Telegram channel with further explanations of the impact on the crypto market and BTC. So finally, by understanding these key pieces of data, you can anticipate how markets may react and position yourself accordingly. The news can make or break your trading strategy. By learning to analyze macroeconomic reports like non-farm payrolls, unemployment rates, and Federal Reserve decisions, you will have a much clearer picture of market trends and opportunities. Don't let price movements catch you off guard again. Make sure to keep an eye on these key events, and most importantly, always dig deeper into the reasons behind the market moves.